tougher. Martin Henniker is of Teich Group Senior Manager. Very good day. Thanks for joining us today. Let's have a look. I was just looking at some of the notes you gave us and your market report here as well. You used the phrase expected depression in the US. Now, we're not talking recession, we're talking depression then. How bad will it be in that case?
Well, first of all, recession isn't really any news because everybody knows basically, apart from Ben Bernanke, that we are already in a recession.
Well, technically not, of course. We haven't had
technically, yes, because they use, they kind of manipulate the inflation figure. So if they adjust the GDP for the real inflation figures, then we are already in a recession. Also, what they don't look at in the calculation is how much new debt do they actually need to take on to generate these, higher GDP numbers. So if you take those into account, we are definitely in a recession, and most independent analysts, actually say that. Even I believe Greenspan was saying that we have just slid into a recession. So, but again, there's still so much debt that has to, be worked through this through the system. 53 trillion, U.S. total debt. If you look at the whole picture, private households, government, and so on. And, that is not even nearly being resolved. So we think it will get much, much worse, potentially worse than the 1929 Great Depression.
Right, that's what I mean. I mean, when we talk about things like the Great Depression, we think of things like 30% unemployment rates and, sky-high prices compared to salaries and so on. Is that what you're looking at?
Well, if you do look at the leverage ratios, at the debt out there, all the numbers actually suggest that now the U.S. is in a worse position than it was back then. And one of the main differences actually is that this time around, the government debt also is basically out of control. You had even a report from the Federal Reserve Bank of St. Louis that we were talking about the other day saying the United States is bankrupt insofar as it can't meet its unfunded liabilities. And that wasn't actually even the case in the Great Depression. So at this time, we could actually see a hyperinflationary rather than a deflationary depression, the outcome really being a Weimar type of Germany hyperinflation.
Well, I want to bring that up because when you say hyperinflation, we've got a good example at the moment in the world in Zimbabwe, but there the fundamentals are very different. That was a supply collapse for political reasons. In the Weimar Republic, it was basically this huge demand for currency to pay reparations from the First World War, and so much currency was printed that, supply didn't keep up. Is that basically the parallel you're drawing there?
Well, basically, there have been different reasons. In the Weimar Republic, it was a war and the repatriation they couldn't afford to pay. Basically different reasons, but the result of those reasons was that the debt is out of control, that they can't meet the debt payments. And again, that has been shown and proven in the reports that these numbers of debt and the future unfunded liabilities, including the payments that have already been committed to, that those can't be met. So whatever has caused it, it doesn't really matter. The financial balance sheet of the United States doesn't look particularly healthy, and it looks really suggesting that there's some fundamental flaw. And even now, the Federal Reserve, even if they were competent, there's really nothing they could do about it. If they raise rate, it would kill the economy. As a result, kills the dollar. If they don't raise it, the dollar will face further pressure and the economy.
Okay, so something's got to fail. So protect yourself is your message, and you've said this in the past by the kind of assets that people actually want. That basically means commodities, although gold is, because of limited supply, as a store of value. To a certain extent, silver as well. To some extent, soft commodities because people have to eat. You're less certain about energy, though. Why is that?
Well, there could be a temporary reduced demand for energy because energy is used for industries, and that's a large part of it. Of course, now recently you have also investment demand, people looking at this as an inflation hedge, but mostly it's still an industrial, commodity. And so if you do have a depression in the United States, and we're not much more optimistic about Europe either, so that could dampen demand, at least temporarily. Besides, on the supply side, the picture is much less clear in our view than, say, for gold, where gold is really running out in South Africa and even Australia is down. But on the supply side, in oil, there has also been much talk about, big reserves that have been found in Alaska and other places. So it's not so clear.
Okay. And just one quick note. If people think let's avoid the dollar and buy the euro because it's a nice big reserve currency, you say they're mistaken as well.
Yeah, exactly. Again, if you're looking at some countries in the Eurozone, they look much worse actually than the United States. Now, you look at Spain, they play good football, but that's about it. If you're looking at the trade deficit as a percentage of the GDP, that's worse than the US. They have a worse housing bubble, and 97% of that is on floating interest rates. And you look at Greece, France, the Premier has admitted that the country is bankrupt, basically. So I don't think it's another option. Precious metal, the first one. But we also like the renminbi still, and with the recent sell-off in the Asian markets, that's maybe a good way to look at cautiously gaining renminbi is through buying back some Chinese stocks.
Okay, Martin, thank you very much.